Yeah.
What am I talking about?
Well, I want to take one step back before we
Do
get
it.
into that.
Go.
Because
You take it where you need to take it.
you mentioned that we're going to do a couple of these sessions and talk a
Yes.
little bit more about not quite the basics, but
No.
principles in ERP implementation that people don't talk about all the time. And this is going to be pertinent specifically to asset-based accounting. But we suffer from, as implementers, we can suffer from what I like to call the wedding photographer problem, which is you become so used to doing this thing that for everyone that you're dealing with, for your clients, is hopefully something they only have to go through once, maybe twice in their whole entire lives, right? So whether it's asset-based accounting or any topic in ERP implementation, it's this thing that we get totally stuck in our own worlds of like, obviously this is the way that it works. I've done this 1,000 times, but the people that you're working with, even if they're fantastic in inventory control or in accounting or whatever it might be, like they're not going to implement ERP every day. And so you really have to kind of take a step back and make sure that you and they understand the basics and the principles before you get into the details. So this is an opportunity
interesting
to talk about
because
that.
every wedding photographer I've ever dealt with
Yeah.
just kind of yanks you here, yanks you there, forces your head this way and that way.
Right.
So you're saying maybe a gentler touch and a little more sympathy for the folks
who
are
not
getting
their photo taken all the time.
Right, who are about to be squeezed through the meat grinder of an ERP implementation.
Yeah, absolutely.
Okay, so let's get on to it.
So asset-based accounting, at its simplest, it just means that you, in your books, keep track of the value of your inventory.
Right.
Which is extremely important for many reasons. I think one of the biggest ones is because when you go to a bank or an investor to borrow money to grow and expand your business, they're going to look at the value of the inventory you have on hand in order to feel comfortable giving you money to grow your business. And it has to be accurate. They're going to assume that it's accurate.
Right, and let's put it that in an extreme case. So I'll say two things. One, everyone who's been through high school economics class with a little bit of basics of accounting that comes in there, I mean, everyone gets a little flavor of it, can understand that on a balance sheet will be a line item, maybe more than one, but let's say one line item says inventory.
Yeah.
You know, and I'll say in those little cases of a small business, $500,000 of inventory. Right. And I know we're going to do the reveal in a second but I'll go to the other extreme to illustrate your point. You know, Walmart. If Walmart has $500 billion of annual sales, and if it turns its inventory only 4 or 5 times a year, you know, and in some categories it's much, much faster, but actually when you take inventory in their supply chain all the way to the store, it's actually not like it maybe 6 times a year.
Yeah.
That will mean they're sitting on $100 billion of inventory. Right?
At any given moment.
At any given moment. And so to your point about the accountants want to know that number, 100 billion, very large number, is real.
Yes.
There has to be some certainty to it. So now if I go back to picture in a warehouse, you know, what does $100 billion of inventory look like? Well, it's boxes on pallets, thousands of locations, tens of thousands of locations in facilities, and then multiplied 50 or 60 times across all the facilities in the network.
And when you're talking about an organization as big as Walmart, or not even as big as Walmart.
Not even, yeah, right.
If you weren't keeping track of these things on a minute-by-minute, hour-by-hour basis, and at the end of a month, somebody went and said, hey, can you find out how much inventory we have on hand, and then I'll plug it into my spreadsheet and we'll figure out how much it's worth based on the costs associated with all those items, that would take months.
Right.
And it wouldn't be accurate. Counts.
Right.
Because there's inventories flowing all day, every day.
You think about it, you think about in the old days, and by the old days I mean like the 60s, where you really would have to stop all operations. In fact, as a kid, I remember in high school, I had a friend who worked in a clothing store, and twice a year they closed the store down for the weekend, busy, and we would go in. For one day I was an employee, and we would count everything in the store.
Yep.
So that big physical inventory, which companies are still doing, even if they shouldn't be, and that big physical inventory, as you said, is going to reveal massive discrepancies between what the balance sheet reports, what the accountants report, and what's physically there.
Right.
Because between the long periods of time that you do these physical inventories, there are 180 days to 365 days in which little tiny errors are accumulating.
Yeah.
And they're accumulating upon accumulation upon accumulation where they become big discrepancies.
Right.
And the old joke was everyone was always bragging. Like they'd say, hey, you know, my accounting team said I had $10 million of inventory. Turns out I have $10 million of inventory.
Yes.
And what they don't tell you, of course, is they've made a $1 million adjustment up and a $1 million adjustment down.
Right.
So I had the $10 million. I just didn't know what I had.
And this is a perfect place to start, I think, our story, which is there's the unsophisticated kind of basic way of doing this, and then there's the sophisticated real-time software-enabled way of doing this. And I want to talk about what those two things look like, and specifically because we're talking about ERP implementation, what the transition looks like.
All right, let's do it.
And the implications for teams that normally don't communicate very well, having to get on board about processes that are now inextricably linked because you are doing things in real time.
So it seems obvious that this path is tell us what the unsophisticated is, then what the sophisticated is, and how I get there.
Yes.
All right, go for it.
So the unsophisticated way of doing this is you keep your inventory movement in terms of, you know, quantity purchased, received, sold, and fulfilled, and, you know, potentially adjusted or transferred or whatever it might be, completely separate from your inventory valuation. And at the end of your accounting period, probably at the end of the month, the accountants will call up the inventory folks and say, give me your inventory for the end of the month, and we will make all our adjustments. We will value that inventory based on the costs associated with the items. This is obviously big, very laborious, relies on offline spreadsheet work most of the time, or, you know, totally separate inventory valuation and control software.
Right.
Super disconnected and asynchronous, right? Like you're going to be doing a whole bunch of stuff throughout the month, and then you're going to be doing all your calculations at the end of the month, and then it's going to be someone's job to figure out what all those numbers mean at the end of the month and where the inventory went.
Yep.
And importantly, and I know we'll talk more about this in a different episode, but like what it cost to get that inventory in and out the door. Because that, at the end of the day, is the most important thing on a transaction by transaction, item by item level. Like, how much money did I make from selling those goods? And how much do I have in inventory, both in terms of dollars and quantity at the end of the month?
I mean, especially you think about like food,
yeah,
where the price of product can vary quite frequently,
yes,
because the turns, especially in perishables, are so high.
Yeah.
So I get the point. Okay.
And and especially in food, the adjustments are going to be so frequent.
The scraps, they didn't meet
Donations,
quality.
Yeah, exactly.
Absolutely.
Yeah. So I'll give you kind of the sales pitch of the sophisticated way of doing this with ERP, and then I want to talk about kind of the particularities and where, in my experience, people haven't always considered the impacts. So the sales pitch is, if your real-time transactional system is integrated with your process and is also integrated, as ERPs are, with the core accounting functionality of your business, then every time an item is bought, sold, transferred, adjusted, the accounting impact of that exact transaction at the exact item level is posted immediately. So instead of at the end of the week or at the end of the month or at the end of the quarter or whatever your accounting period is, or period for making these adjustments are, having to do all those calculations and figure out what happened, you can actually go on a given transaction, not just say, what item is this transaction referring to? What is the quantity on that transaction? Where did it move? Who did it get sold to? What was the cost? But also right there is the GL impact, the general ledger impact, the accounting impact. Where did my asset account go? Where did my COGS account go? Where did my expense account go? Whatever the case may be.
In other words, whereas in the traditional old-fashioned sense, I would never honestly have an accurate inventory. Okay, my inventory valuation is always off in this because of all the asynchronous and disconnected issues or issues that arise from those two features.
Right.
Not only that, but between periods of reporting and adjustment making, the inventory is, at least from a general ledger perspective, mysterious. It's really unknown. And we move from that to,
it's Tuesday morning. I want to know what
in theory, Tuesday morning 9:17, right?
Yep.
Where I'm halfway through my receiving a shift, and then Tuesday morning 11:23, and I'm almost done my receiving shift. I actually will have a different reporting of the inventory because I have received and posted those receipts to the general ledger.
Yeah, and if I'm a curious accountant and I want to be doing daily or weekly discrepancy checks and reconciliations, those can happen at whatever time interval makes sense for those teams because they can go in and see the accounting impact in real time of transactions as they post, rather than retroactively looking back at those transactions and trying to figure out what the accounting impact is.
And practically speaking, no accountant really cares to that level.
No.
However, being able to provide that assurance of quality and consistency to your bankers, to your investors, and to potential investors is actually quite a powerful thing.
And I think super importantly to define a process in software that will work regardless of the location that you're talking about or the warehouse that you're talking about. You build, I mean, the software has it out of the box.
Across sites. Yeah. The consistency, the sort of the depersonalization of how things get done. Right. Okay.
You're defining the accounting impacts generally and then watching them occur rather than maintaining 8 different processes that all happen asynchronously across different sites.
Yep.
Not that you're ever going to eliminate the discrepancies and inaccuracies. Not that cycle counting is never going to be part of your process.
Right.
But you do benefit from this real-time
100%
account. Yeah.
You in theory, at least it should be the level of error is greatly diminished. So I think everyone listening could understand that.
Yes.
So now let's get into like so what's so hard to transition to that?
Yeah, absolutely. And I don't think it's necessarily difficult to transition. It just requires thinking about things that teams don't always think about.
Right.
And I come to this through the world of software, not through the world of accounting.
Right.
So again, it's kind of that problem of I see it done one way, and so I assume that it's obvious or makes perfect sense. But I mean, especially lately, I've been trying to introduce this topic earlier and earlier and earlier in the implementation process because really, at the end of the day, like the accountants and the people who deal with inventory need to, at least for the time that you're doing the implementation cutover, get on the same page about how inventory movement, whether it's receiving or transferring or adjusting or fulfilling, affects the accounting team. Because there is this luxury in the unsophisticated way of doing things where you say, I'm going to take care of the inventory. All I have to keep track of is where my inventory is and what happened to it. And then I'll hand all of that information in aggregate over to the accountants, and they'll deal with it later. And they might send me annoying emails asking about what happened and where is this transaction and why is there no reason associated with this adjustment. But like, I'm not going to get errors from my software saying, hey, you can't do that because it doesn't make sense from an accounting perspective. Your inventory might not be, you might set up your inventory, for instance, to never be allowed to go below 0. And so, whereas in the unsophisticated way of doing it, I would just write in my spreadsheet or whatever software I was using, -10, and all of a sudden my inventory is negative.
Yep.
Now there's this, blocker to that because it needs to make sense in real time from an accounting perspective.
And I know the operators listening to this.
Yes.
Like the how can inventory go negative is something that prima facie, like on the surface, you go, well, of course inventory should never be allowed to go negative.
Right.
But the operator in the warehouse at 2 a.m. who's got to get an order out, and the truck has to be dispatched by 4 because it's a 3-hour drive before they can get into Ottawa or whatever, or into to pick your secondary.
Getting an error on their device over and over and over again, saying you can't do that is annoying.
And so in the old days, you've got a box, a case of lettuce sitting right there, and your inventory system says you have no lettuce. And you know that this is an error, a systematic error, and I see that case of lettuce, and that's the only thing I need to get an entire truck out.
Right.
Well, guess what I'm going to do? I'm going to pick that lettuce, and my inventory is going to say I have -1 cases of lettuce.
Right.
It's like
you need to let that happen.
Yeah. And then your point is now I'm going to introduce a system or a discipline where that just is not allowed.
Right. Yeah, or where you have to figure out in real time rather than, at the end of the month, what the impacts of going into the negative are from an accounting perspective.
Right.
And this is where, and I think the benefits far outweigh the negatives here, but this is where when you're going into an ERP implementation, your accounting team has to be prepared to sit in on conversations about use cases and about specific edge cases in inventory management and inventory control, which they may never have wanted to deal with before, because they rightfully will say, like, I don't care if you're trying to fulfill something at 2 o'clock in the morning. Like, there's no accounting impact there. Put the lettuce on the truck, write it down, and I'll deal with it later. And, that's where I think it's just really important that the accounting team is prepared for and becomes involved in those conversations from the beginning of the project. Because every single thing that happens is going to have an accounting.
What happens if they don't? Let's say this is a classic implementation problem across all software, probably across all human activity where software is being implemented,
right.
Is projects begin with a core group of people who are really interested in how it gets implemented, and then absolutely critical but peripheral people who are not interested at all. Right? And it's like, I don't want to be involved in this. It's sticky, hard thinking. I just want to do my job and go home. What happens if that conversation starts too late?
One of two things. Either you're not going to define the use cases entirely, and you are going to end up implemented successfully, but you're going to get errors in your first day, week, month, year that you're going to really frustrate users, exactly like what we're describing, where it's 2 o'clock in the morning and somebody's trying to get lettuce on a truck. Or you are going to solve for those problems, but the accounting team is not going to be involved in the solution for those problems, and it's going to use either the default or kind of the assumed functionality, and the accountants at the end of the first, second, maybe first year of accounting period closes are going to say, what happened? I don't understand the impact of these transactions. Why are there variances in this account when I've never seen variances in that account before? Or there's a system account that I don't recognize that gets hit because that's the default accounting impact of a inventory adjustment transaction. And I haven't seen that before. I wasn't prepared for that. I don't know why it's there. It's a new account.
Yep. All right. So could you maybe talk us through a specific example? Anything on your,
Yeah, I mean, a really straightforward example is inventory adjustments. So you have to marry the notion of an inventory adjustment reason with an accounting impact associated with that reason. And it's one of these things that if you're doing this in the kind of unsophisticated way, you have the luxury of not having to deal with that in real time. I can write down the reason in words on a piece of paper or in a spreadsheet or whatever tool I'm using that's like, this expired, or I opened the box and I saw something was off, and I can deal with the accounting impact of that later. But early on, you're going to want to define what your set of reason codes are, maybe make some exceptional reason codes for things that are going to be other than what are the main 5 or 10 reasons that you adjust inventory in or out, and then map those reason codes before you're implemented to their general ledger accounts. So you might have a ton of accounts that are specific to different adjustment reasons. You might only have one adjustment reason.
Just to help me, though.
Yeah.
Pick 2 reasons and why they would be mapped to 2 different general ledger accounts.
Right. So you could have, let's talk about food. You could have expiry and donations.
Okay.
So, there's certain conditions at which the inventory is not sellable anymore for your customer base because, maybe they have shelf life requirements that are distinct.
Yes.
And then you might have stuff that just straight up expires that you're not going to donate.
Yep.
And you're going to want to account for those two things differently. You're going to want to have them as separate accounts because
the donation, I'm going to collect that value and I'm going to claim a tax credit. And expiry, I don't have that.
Right. And as we've been talking about this whole time, we want that stuff to happen in real time. We don't want to have to go back at the end of the month
and say, well, how much did I give to donations and how much did I have to scrap altogether?
Right, because it's going to hold up. It's going to hold up your close. It's going to hold up your tax reporting, all sorts of things. So you're going to define. Very basically, you're going to define those reason codes. You're going to require those reason codes to be selected. You might have a default one so that, in the event that 90% of your adjustments happen for one reason, you're not going to require intervention by a user on the floor. And you're going to map those reason codes to accounts, and so that when you adjust in or out for one of those 2 reasons, those in real time rather than retroactively are hitting the.
Yeah, that makes a ton of sense to me. So, what if I think about NetSuite?
Yeah.
What should I be thinking about specifically in the NetSuite world?
If I before you even get started on implementation, you want to get buy-in from everyone who's going to be impacted, even if during the sales cycle or during your kind of imagination of what the project is going to look like, you think that, like you said, those teams might be on the periphery of absolute involvement in the project, because ERP implementation, for this reason and for a whole bunch of other reasons, are successful because the people who are impacted by it, who are going to be ultimately using and manipulating the software, want to go live with a new system, or at the very least are willing to transition to the new system. And I think that's really the distinction between a successful and an unsuccessful implementation at the end of the day. Even if we're not, even more than just kind of the specifics of asset-based accounting, if you have people who are going to be impacted, who are going to be using the system, who are going to be required to manipulate data within the system and think about the requirements and use cases, and they're not interested and don't want to attend those meetings and think that they have more important things to do, it's going to be really hard to make that project successful. And so I think that's just one of these reality things that not everyone talks about during the sales cycle and during kind of imagining these projects, because we are fundamentally optimistic about software transition.
An ounce of pain in the implementation is equal to a pound of pain post-implementation.
Yeah, if not way more than that.
Exactly.
Yeah, it's exponential.
Take your lumps early, suffer through it, and you'll have a lot of. And the funny part of it is, of course, they'll never know what they could have run into if they didn't do it. So
that gets back to the kind of plumber analogy of the work that we do, which is like, on a good day, no one ever says,
no one thanks
great
us.
Job on your ERP implementation, like everything works perfectly.
Not
on a bad
true.
day, your bathroom is overflowing and you have to call a plumber. So yeah,
that's very funny.
Yeah.
So have we done it?
I think we have.
All right.
More to come.
Sorry?
More to come.
More to come. Yeah, I think there are so many exciting things, but I really appreciate that General Ledger example of expiry versus charity. I think it highlights, it makes it really crystal clear for me, and I think that for the viewers and listeners,
the millions of people out there watching.
Right, the legion of fans, exactly why this mapping to the General Ledger is such an important, even if slightly tedious, project within the project.
Yeah.
So I really appreciate that, Isaiah, and I look forward to our next conversation.
Fantastic. Grateful for the time.
Have a great weekend, by the way.
Thank you.